Okay, so after doing the 10 MCQs, we should move forward to MCQ number 11. MCQ number 11, which is on your screen, a manufacturing company uses machine C, which is operational for 5 hours a day to manufacture 4 products WXYZ. Factory costs are 150,000 per day. The company uses throughput accounting and its objective is to maximize profits. Okay, so the important thing is that company uses throughput accounting. So manufacturing company uses machine C, it's operational for 5 hours a day to manufacture 4 products WXYZ. Factory costs are 150,000 per day. Company uses throughput accounting. Its objective is to maximize profits. Information relating to these products are WXYZ. Selling price is given. Material cost is given. So you can deduct to get throughput, and conversion cost is given. Now production rate per hour. Production rate per hour is 200 units of W. That means 200 units are made per hour. X 500 units are made per hour, Y 400 units are made per hour, that's the rate per hour, and 350 units of Z per hour. If the company is not able to increase the availability of machine C's operational hours, what is the production ranking? That's a very, very easy question of throughput accounting which asks for ranking. Okay. Now, if we talk about question number 11, there are 4 products, W, X, Y, and Z. Okay, so selling price is given, material cost is given, and production rate, units per hour. Okay, so let's check about the selling price. It's 350, 190, 270, 215. 350, 190, 270, 215. This is the selling price. And what about the material cost? 120, 95, 160, 75. 120, 95, 160, 75. Okay. How many hours each unit is taking? It's not given. Units per hour. W 200 units per hour, then 500 units per hour, 400 units per hour, 350 units per hour, 200, 500, 400, 350. Okay, and it's asking what is the ranking. It's asking what is the ranking. Now, it's a very easy question of throughput accounting. You know that ranking comes in 4 steps. Companies using throughput accounting, right? It's not using marginal costing, it's using throughput accounting. Throughput accounting states that the first step is identify limiting factor if you have studied from me. Then second step in marginal costing was contribution per unit, then is throughput per unit. Okay. The third step is throughput per hour. And on the basis of that throughput per hour, we do ranking. Okay. So we do ranking on the basis of throughput per hour. So we need to find the throughput. So selling price less material cost, it's 350 less 120. So C3 minus C4. So throughput of each product. Okay. And hours per unit. Remember, we don't need how many units is made in 1 hour. We need how many hours each unit takes. You can refer to my lecture in which I solved the question of right limited in throughput accounting. You can refer to my lecture in which I solved the question of right limited. We never need how many units are made in 1 hour. We need how many hours each unit is requiring. So product C, 200 units in 1 hour. Product C, 200 units are made in 1 hour. So if 200 units are made in 1 hour, how many hours 1 unit is taking? You need to do 1 divided by 200. Okay. Similarly, if 500 units are made in 1 hour, 500 units 1 hour. So 1 unit is 1 over 500. Okay. Then Y, it's 400 units in 1 hour. So 1 unit 1 over 400. And for Z, 350 units per hour. So 350 units in 1 hour. You don't need how many units are made in 1 hour. You need how many hours each unit is taking. So 350 units 1 hour. 1 unit is taking 1 over 350. So you have got the selling price, you have got the material cost, you deduct it to get throughput, and then you don't need how many units is made in 1 hour, you need how many hours each unit takes. You have that. So you have throughput, you have hours. Now you can get throughput per limiting factor, also called throughput per hour. Okay, you have the throughput in cell C6 divided by hours, C7. Okay, so which is giving the highest throughput per hour? 46, 47, 500, 44, 49. This is going to be the first one. Then second, third, fourth. Okay, this is the solution of MCQ number 11. Again, I'm telling you, those who are failing to understand this, they should refer to my lecture of throughput accounting of Wright Limited. Ranking is required. Ranking is always done on throughput per hour. So you have the selling price and material cost to get throughput, divide by hours each unit is taking. It's not given. 200 units are made in 1 hour. So 1 unit is 1 over 200. You get throughput and hours divided to get throughput per hour. Okay, please copy this. Okay, so it's for the general question of very easy question of ranking. You just took selling price, deducted material cost to get throughput, divided by the hours. Hours were not given, same as Wright Limited in my lectures. And you get 1 unit, 1 hour is 200 units, so 1 unit is 1 over 200. You get throughput per hour and 2 ranking. Okay, so first is Z. That's why the answer of this question is what is the production ranking of Y? So I can see Y's ranking is 4th. Okay. 12th. This question is not related to any particular topic. It's a very easy general question. People always expect that everything will come just from the syllabus area. That's true, but general MCQs can come. Okay. The cost of running a company's IT department is 2.4 million per annum. 90% of the time in department is spent on recording transactions and 10% on responding to online information requests from manager. Okay. Question 12. The cost of running IT department is 2.4 million. Okay. 90% time is spent on recording, so 90% time is spent on recording. Take 90% of 24 million, 2.4 million, and 10% time is spent on responding to online information requests from managers. Okay. So 10% is spent on information requests. Just did some working on the first paragraph that cost of running the company's IT department is 2.4 million. 90% of time in the department is spent on recording transactions and 10% on responding to online requests. So it's split 90-10. There are two types of information requests. Now, how much time was spent on information requests? 10% was spent on information requests. Now, there are two types of information requests: full reports, specific queries. A full report takes twice time as specific query, and each month there are 4,000 specific queries and 500 requests for full reports. Costs are apportioned on the basis of time. So costs are apportioned on the basis of time. What is the estimated cost per specific query? Now, second paragraph is interesting. First paragraph was very easy. That cost of running company's IT department is 2.4 million. Okay, cost of running IT department is 2.4 million. A recorded cost is 2.4 million. 90% is on accounting transactions, split it, and 10% on online requests was split that. Now, 10% was spent on online requests. Two types of information requests: full specific queries. Full report takes twice time as specific query. Each month there are 4,000 specific queries and 500 requests for full reports. Costs are apportioned on the basis of processing time. What is the cost per specific query? Now, the cost was 2.4 million. 90% was on recording and 10% was information request as submitted. Now, there are two information requests. One is specific query. One is full report. Two information requests. One is specific query. One is full report. Okay. Two types of information requests: full reports, specific queries. Full reports take twice the time as specific query. So let us say full report takes twice the time as specific query. So time. Full report takes twice the time as specific query. Assume specific query is taking 1 hour. Full report is taking 2 hours. You can put any dummy figure. A full report takes twice the time as specific query is written. So if specific query takes 2 hours, it takes 4. Put any figure. If specific query takes 5 hours, it takes 10 hours. If specific query takes 1 hour, full report takes 2 hours. This is what this means. That full report takes twice the time as specific query. Each month there are 4,000 specific queries and 500 requests for full reports. So number 4,000 specific queries, 500 full reports. Okay. Costs are apportioned on the basis of time. Now you will apportion costs on the basis of time. So if specific query takes 1 hour, full report takes twice time, 2 hours, you can put any figure. Number is 4,500. So total hours for specific query will be 1 hour, 4,000 queries, 4,000 hours, and 2 hours, 500,000. So costs are apportioned on the basis of time. So if you apportion costs on the basis of time, the cost is not 2.4 million to be apportioned, right? Only 240,000. This cost will be apportioned. Okay. Why? You want a portion whole of 2.4 million, only 240,000. Why? Cost of running company's IT department is 2.4 million per annum. 90% is spent on recording transactions and 10% on online requests. And there are two types of information requests. 10% on information requests. There are two information requests. So you will only apportion the cost of information requests. So if cost is apportioned on the basis of time, the time of specific query is 4,000 out of total hours is 5,000. Okay, if you apportion cost on the basis of hours, so total hours are 5,000, right? So if you apportion cost on specific query, the specific query time is B24,000 divided by total T20 into how much cost? 240,000, 190,000. And on full report, how much cost apportioned? It's on the basis of time. So time is 1,000 hours divided by total 5,000 into amount 240,000. So you have got the cost of both. Okay, so I've just done this. That cost of IT department was 2.4 million. 90% was on recording, 10% on information request. Split it. There are two information requests. Specific query, full report. Full report takes twice time as specific query. So if specific query 1 hour, full report 2 hours, or put any number. 4,000 queries, 500 reports, so total hours are 4,000 and 1,000. And I split the cost a portion on the basis of time, on the basis of 4,000 hours over 5,000 into cost of 240,000, specific query cost and full report cost. Now, what is the cost per query? It's very simple. What is the cost of specific query? Okay, it's 192,000. Okay, and you need cost for per specific query. So cost is 192,000. And if you need cost per specific query, how many specific queries are there? 4,000. We will get cost per specific query as 48. Now, even if you put any hours, the only thing is full report takes twice hours. So you put specific query takes 5 hours, 10 hours, still you get 48. Okay, specific query takes 20 hours, full report takes twice 10, 40 hours, still 48. Specific query takes 3 hours, full report takes twice 10, 6 hours, still 48. Specific query takes 1 hour, full report takes twice hours, 2 hours. Okay, so cost per specific query, get the cost of the specific query, a portion on the basis of hours, and divide it by the number of queries. Okay, please note it. So the answer is 48. There is just a small error in this. I need to correct it. That this cost was per annum. Cost of running IT department is 2.4 million per annum, and the queries was given for each month. Okay, so you have taken the cost of per annum. This 2.4 million, 240,000 is per annum, and this is per month. Okay, so for B21, the 240,000 costs, it's for whole year, so I need to take queries of whole year as well. So 4,000 is the monthly query, yearly queries would be 48,000. Okay, it's 4. Okay. Oh, sorry for the error. Please correct it. The answer is 4. Because since cost was taken off per annum, so queries should also be per annum. The 4,000 queries are each month. So for per annum, it's multiplied by 12. Okay, now MCQ number 13 relates to another topic of rolling budgets, very important area of the syllabus. Broad company produces quarterly rolling budgets. Okay, so company makes quarterly rolling budgets and it forecasts the cost of material purchases for the next 4 quarters 1, 2, 3, 4. Purchases at quarter 1 were budgeted to be 220,000. It was anticipated that the cost of material would rise at a rate of 2% per quarter. Okay, so it makes a rolling budget, had forecast the cost of material purchases for the next 4 quarters. So it has forecasted the cost of material purchases for the next 4 quarters. For the next 4 quarters. Okay. So broad company produces quarterly rolling budgets, has forecast the cost of material purchases for the next 4 quarters, 1 to 4. Purchases for quarter 1 were budgeted to be 220,000 and anticipated that cost would rise at the rate of 2% per quarter. So purchases for quarter 1 are budgeted at 220,000. And it was anticipated that they will rise by 2% per quarter. So increase by 2%. B26 increased by 2%. That means became 102%. And the previous one, C26, 2% per quarter, and then D26, 2% per quarter. Okay, this is what it says. That broad company produces quarterly rolling budgets, had forecast the cost of material purchases for the next 4 quarters, 1, 2, 3, 4. Okay, so purchases for quarter 1 were 220,000, and it was anticipated that the cost of materials would rise at a rate of 2% per quarter. Okay, at the end of quarter 1, you made a budget for 4 quarters, 1, 2, 3, 4. 220,000 was budgeted and 2% per quarter was the rise. At the end of quarter 1, actual material purchases were recorded as 210,000. Okay, so actually at the end of quarter 1, the actual purchases for quarter 1 was 210,000. You made a budget of 220, but actual purchases was 210,000. Okay. So Brad produces quarterly rolling budgets, has forecast the cost of material purchases for the next 4 quarter. Purchases were budgeted to be 220 and they will rise at 2% per quarter. So I made the purchases 220 in quarter 1 and rise it by 2% per quarter. At the end of quarter 1, actual material purchases were 210,000. I wrote actual purchases 210,000. This was due to a change of material supply during the quarter. A revised estimate for the increase in material cost purchase was made. The rise was now predicted to be only 1% per quarter. Now it was estimated. You made budget at 2% per quarter. Now it was anticipated only 1% per quarter. The budget was updated. What estimate for total annual material purchases should be recorded in the updated budget? What estimate for total annual material purchases should be recorded in the updated budget? It's very simple. You made a budget of first 4 quarters, right? You made a budget for first 4 quarters, 1, 2, 3, 4. Okay, and the budget you made of quarter 1, 2, 3, 4, 220,000 was for the first quarter, and it increases by 2%, right? Actual purchase was 210, and now it was anticipated that it would only be 1% per quarter. So you need a figure for total annual material purchase budget. Okay, total annual material purchase budget in the updated budget. Okay, in the updated budget. Now, if it asks total as per the old, so as per the old, the total would just be the sum of all. E26 till E26. Simple, total annual. Okay. but it's not asking the total annual material purchase as per the old budget. It's asking as per the updated budget. Now, you know the principles of rolling budgets. Rolling budget principle is that the budget should be updated. Now, actual results were 210, and now it was estimated only 1% per quarter. So you should make the next quarter's budget revising that. So now budget for the next quarter would be 210,000 B27, because in rolling budgets we never start from the budget, we start for actual. This is taught to you, right? In rolling budgets, updated budgets, we never start from budget, we start from actual. So quarter one has ended, 210,000 is the figure, and I need to update it according to 1% per quarter. So update it 101% now. Okay, keep updating. Okay. Sir, why have you updated budgets 4 times? I got this correctly that I will update it 1% per quarter from 210, but why 4 quarters? It's asking for annual budget. Okay. And remember, rolling budget is always made for 1 year. Okay, so that's the principle of rolling budget. When 1 quarter is ended, you will make updated budget again for the next whole year. When quarter 2 will end, you will again update budget for the next whole year, 12 months or 4 quarters. So the total annual budget, assuming this 1% rise was easy, but you have to make for 4 quarters. That's the principle of rolling budgets. Budget is always made for 1 year, and annual means for the whole year. You cannot keep 3 quarters in 1 year. You have to make the next 4 quarters. The total will be the sum of 861211. Okay, please copy this. You made it according to 2% per quarter. It was simple. Quarter 1 ended. 210 was the figure, and now we decided 1% per quarter. Annual budget, after revision, revised budget, so make for whole annual 4 quarters by rising at 1%. Okay. $14 is a very easy question, and it states that which 2 of the following activities are internal failure costs. Now, in total quality management topic, I have taught you 4 things: prevention costs, appraisal cost or inspection costs, internal failure cost, and external failure cost. Okay, there are 4 costs: prevention costs, Appraisal or inspection cost, internal failure cost, external failure cost. Any cost incurred with the objective of preventing something, that's a prevention cost. Any cost incurred on inspection, it's an appraisal cost. Any cost incurred as a result of error, that's internal failure cost. And any cost incurred after the product leaves the factory or premises, that's an external failure cost. Okay. So which two of the following are internal failure costs? Quality control inspections to monitor pollution levels. So inspection is basically an appraisal cost. Inspection is basically an appraisal cost. Water purification treatment to clean wastewater before it leaves the factory. Okay, so before it leaves the factory can be internal failure. Let's see. Fitting of carbon filters to machine processes to reduce carbon emissions. To reduce carbon emissions, you are fitting carbon filters to reduce emissions. That means you want to prevent fines and penalties because you are fitting carbon filters to reduce carbon emissions. You are trying to prevent carbon emissions. This is a prevention cost. Power usage measuring system to monitor energy consumption within the factory. Power usage measuring system to monitor energy consumption. Again, you don't want more energy to be consumed. This is also a prevention cost because you don't want more energy to be consumed. That's why you're installing power system. Payment of fines for breaching environmental regulations. Payment of fines for breaching laws. You broke the laws. That's why you have to pay fines. That's an external failure cost. Fines and penalties are external failure. Installation of heating pipes to reduce heat loss. You are trying to reduce heat loss. This is also prevention cost. Public relation cost to remedy reputational damage caused by accidental pollution. Again, public relational cost to remedy the failure has happened. External failure cost. So capturing and recycling of waste. Recycling of waste. Internal failure. Water purification treatment before it leaves the factory, internal failure. Okay. So inspections, quality control, it's an appraisal cost. Carbon filters to reduce emissions, a prevention cost. Power usage system to reduce energy consumption or monitor, it's a prevention cost. Okay. To reduce heat loss, that's also a prevention cost. Fines and reputational cost, that's external failure cost because it will happen after you do something bad. So B and H will be the internal failure costs. Okay, so MCQ number 15 now. A company had budgeted sales of 30.9 million and market worth 61.8 million. Budgeted sales. Market worth. So company has budgeted sales of 30.9 and market worth 61.8. Okay. When budget was drafted, it was assumed that inflation would be 3%. So when this budget was made, 30.9 on 61.8, inflation was 3%. But it was discovered that inflation had been 2%, and that market had been worth 65 million. Okay. What is the sales revenue figure which should be used when assessing performance? So company made a budget assuming inflation is 3%. Budgeted sales 30.9, market was 61.8, but this budget was made assuming inflation is 3%. That means both these budgets were made at 103%, right? Both these budgets were made at 103% because you assumed that inflation is 3%, and you made two budgets, sales 30.9 million, market were 61.8 million, assuming inflation is 3%. That means these budgets were made assuming 103%. But inflation was 2%. And market was 65 million worth. What is the revenue figure which should be used when assessing company's performance? Okay, what is the better revenue figure? Simply. So assuming inflation is 3%, total 103%, you made budgeted sales 30.9, market were 61.8. But in reality, inflation was 2%. So you should revise your budgets. So 30.9 was made assuming 103%. It's made with 3% inflation. It was 103%. So bring it to 102% by dividing it with 103. So it gets finished from 103 and goes to 02. And similarly, 61.8 was made assuming 3% inflation. It was 103%. So bring it to 2%, 102. Okay. So this was the proper budget, that you budgeted sales 30.6 with 2% and market were 61.8. But actually, the market worth was 65. Okay. That means your budget was that market worth would be 61.2. Actually, market worth was 65. That means growth of market was, take the difference, 6.2%. Okay. Now, what should be the budget for sales? Actually, what sales revenue figure should we use? Now, your budget was 30.6 million. Initially, it was 30.9 and 61.8, but you assumed that inflation is 3%. They were made at 103. But inflation was 2%, so you updated your budget at 102% and the market. Actually, market was 65. That means it's due by 6.2%. So what figure should we use for sales? Now, since market has grown by 61.2 to 65, 6.2%. So your sales reasonable figure should also grow by 6.2%. So 30.6 should increase by 6.2%. It's 32.5 million approximately. What is the revenue figure which should be used? Okay, so it's a simple thing that your budget was 30.9 and 61.8 market when it was assuming inflation 3%. So you made a wrong budget. Inflation was 2%. You need to update your budgets, bring it to 2%. 30.6, 61.2. Actually, market was 65. That means market grew by 6.2. So your sales should also grow by 6.2%. You grew it because the market is growing. Your sales should also grow. 32.5 million should be the correct figure. Okay. Okay, next MCQ, which three of the following statements about ABC and traditional costing system absorption model are correct? So it's asking which three of the following statements are correct. Very easy MCQ of ABC and absorption model. Please read the requirement, which three of the following statements about ABC and traditional absorption model are true. No over under absorption can occur under ABC. This is completely false. Over under absorption does not occur only in marginal costing. In marginal costing, there is no over under absorption. That is the principle, that marginal costing doesn't have any over under absorption. No over under absorption can under ABC. That's wrong. Over under absorption can come in absorption costing as well as ABC. It cannot come in marginal costing. This statement is wrong. ABC is useful for businesses which have high overheads in their cost structure. True. This is what is taught by me as well in my lectures. I have specifically given the statement. If a business has very low overheads, very low, either you use absorption costing, divide everything on hours, or you use activity based costing, divide on drivers. Since overheads are very low, the difference won't be material. You won't get any benefit. But if a business has high overheads, you use absorption, divide them on hours, and then you use ABC, divide them on activities. The difference would be significant. So ABC is useful for those businesses that have high overheads. That's a reality. Okay. ABC is not suitable for use in businesses that provide services. Wrong. ABC can be used for manufacturing service. No one taught you this. Even if you have done past paper question, there is an ABC question regarding a nursing hospital. We have done that MTQ as well. Hospital is a service provider. ABC is for manufacturing service. Both. Never taught you like this. Okay. ABC is better than absorption costing in understanding what causes cost to be incurred. True. ABC is better than absorption. Okay. Marginal costing understates the true cost of a product when compared to ABC. True. You know, in marginal costing, we only take material, labor, variable overheads. We don't take fixed overheads. In marginal costing, we only take material, labor, variable overheads, variable cost. We don't take fixed cost. So marginal costing answer is always low, understated, because it doesn't take fixed cost. So marginal costing understates. This is correct. B, D, E are correct. Both ABC and marginal costing treat fixed costs as product costs. Wrong. This is a thing from F2 management accounting paper. Marginal costing treated fixed costs as period cost, and ABC and absorption costing treat them as product cost. This statement where both ABC marginal treat fixed costs as product cost is wrong. Marginal costing treated fixed costs as period cost. Okay, B, D, E are correct. Okay, MCQ number 17. Which of the following statements is not true about sales mix variance? So, which of the following statements is not true? If actual revenues from two products are in the same ratio as budgeted sales revenues, there is no measurable mix variance. I think this statement is not true. What is the comparison of sales mix variance? You take actual Sales mix variance, you take actual units sold in standard mix, compare with actual units sold in actual mix, which makes mix variance standard profit or standard contribution per unit, mix variance dollars. This is the format. You write product A, product B. Okay. Remember, this mix variance comes here as 0, the net of all. So when does mix variance doesn't come? When actual units sold in standard mix and actual units sold in actual mix, okay, are absolutely same. Then there is no mix variance. When actual units sold in standard mix and actual units sold in actual mix are same. What is this saying? If actual sales revenues from the two products are in the same ratio as budgeted revenues, then there won't be any mix variance. Wrong. If revenues are in the same ratio as budgeted revenues, this is not measured by sales mix variance. Sales mix variance doesn't measure actual revenues and budgeted revenues. It measures this: actual units sold in standard mix and actual units sold in actual mix. So if actual units sold in standard mix and actual units sold in actual mix are in the same ratio, then there won't be any mix variance. But it's saying actual revenues are in the same as budgeted, there won't be any mix variance. This statement is wrong, not true, because mix variance doesn't, it will be 0 when actual units sold and standard mix will be in the same ratio as actual units sold and actual mix. When budget and actual are same, this is not the case. MCQ number 18. LODA has two divisions with the following results. Revenue 1,000, 1240. Variable cost 400, 500. The contribution, divisional fixed cost, allocated reference cost, divisional net loss. So look at division A. The revenue is 1,000, variable cost is 400, contribution 600, divisional fixed cost 650, and allocated reference cost 50. Net loss is 100. And for division B, revenue, variable cost, contribution, fixed cost, lot loss. Okay. Let's just do these. It's division A. Division B. So sales revenue, variable cost, contribution, divisional fixed cost, allocated head office cost, divisions net loss. So revenue of division is 1,000, variable cost is 400. You deduct it to that contribution of 600. Then divisional fixed cost is 650, and allocated fixed cost is 50. So 600 minus 650 and 50, losses 100. Okay. Division B, 1240 revenue, variable cost 500, contribution 740, divisional head office costs 600, 150, negative 10. Okay. That means the total divisional loss at the moment is negative 110. Okay, 100 is here, 10 here. The total divisional loss is 110. So LODA has two divisions, A, B. I wrote the revenue, variable cost, contribution, divisional fixed cost, head office cost, divisional net loss. Now see this statement. If a division is shut down, LODA will avoid all division specific costs and half of the head office costs allocated to the division. Okay. If a division is shut down, LODA will avoid all division specific costs and half of the head office costs. This is the policy that if a division is shut down, LODA will avoid all division specific costs and half of head office allocated costs. Okay. What would be the revised total divisional net loss if LODA chooses to shut down division A? Now, what happens when a division gets shut down? All specific costs are avoided and half of allocated costs are avoided. So what will be the revised total divisional net loss if division is shut down? Very easy. This is the picture of division A and division B. 100 loss, 10 loss. So total loss is 110. What will be the revised loss if division is shut down? Now, please pay attention. It's a very easy question. Now, if division is shut down, how much revenue will you get? 0. Okay. Because no division, no revenues. How much variable cost will you get? 0. No division, no variable cost. Obviously, if the division is shut down, there is no revenue, no product making, no variable cost. So how much contribution will you get? 0. Okay. How much would be the divisional fixed cost? Obviously, it's a division specific fixed cost. If division is shut down, all specific fixed costs are avoided. That's written 0. And if a division is shut down, are all head office costs avoided? No, it's written if a division is shut down, it will avoid all division costs, half of head office costs. So only half of head office costs will be avoided. So instead of 50, 25 will still come. So what will be the loss? No revenues, no variable cost, 0 contribution, no division fixed cost, but allocated first cost will still come of 25. So loss will be 25. So now what would be the net divisional loss if A shut down? 25 here and 10 here. Now it will be negative 35. Such an easy question. Okay, it was 110, 110. If a division is shut down, it will avoid all costs. So A is shut down, 1000 becomes 0, variable cost 0 because cost will be avoided, contribution, divisional fixed cost will be avoided, but FS cost is only half. Half will be avoided, 25 will still come. So loss will be 25 and 10, 35. Okay, please note if you want. Okay, second last MCQ now. It's a very easy question. Usually, the topic of transfer pricing is sometimes tricky for students, but this is a very simple question. Conference company, the divisionalized structure, one of its division, division X, sells its output to other divisions. So one division sells output to other division. Division X annual budgeted output and costs are units sold 15050, material 22500, labor 45350, and overheads 37150. What transfer price per unit will result in a profit margin of 20% for division X? What price per unit, what transfer price per unit will result in a profit margin of 20% for division X? Okay. Now, what is the cost per unit of division X? What is the cost per unit division X? Okay. So costs of division X are 22,500 material, labor 45350, and overheads 37150. If you add them, it's 105,000. So 105,000 is the cost, and how many units it's making? 105,000. So cost per unit is 100. Okay. It has a divisionalized structure. One of its divisions sells output to other divisions. Its output is 1050. The cost is 105,000. So cost per unit is 100. What transfer price per unit will result in a profit margin of 20%? It wants to keep a profit margin of 20%. So you know, when profit margin is 20%, the S minus P chart is profit margin is 20%. Since it's margin, so sales is gonna be 100%. It's not markup, it's margin. So cost balancing figure 100% due to margin and 20% is the profit. The balancing figure cost is gonna be 80%. So cost per unit is 100 and the percentage is 80. You need price at 20% margin. So for price, take that to 100%. So 100 divided by 80%. And price is standing at 100%. So take it to 100% like a typical F2 stuff. The price at 100% is going to be 125. Okay. So you just have the cost per unit and margin needed is 20%. What will be the price? If it's markup, then cost is 100, margin sales 100, just get the price. Last MC. Which of the following are consequences of using ideal standards? I've taught you 4 standards: ideal, attainable, current, basic. So which of the following are consequences of ideal standards? Variance analysis is likely to produce adverse results. Yes, when you set ideal standard, no wastage allowance, no idle time allowance, people don't achieve them because it's practically impossible. They will do wastage, so the variance will always be adverse. Because when you set ideal standard, no wastage allowance, nothing. People will, no matter how much they would try, they won't achieve it. They will still incur wastage, so variance will always be adverse. Demotivation of staff, I've told you ideal standards demotivate employees. Okay. Allowances for normal efficiency levels are made. No, there is no allowance given. 3 is wrong. Okay. Standards can become more useful for long-term targets. Any standard, it's ideal, attainable, or current. They are useful for long-term. So 1, 2, 4 is the answer. Okay. This ends your MCQ session. We did 10 MCQs in the first session, 10 here. These are very important MCQs. Do them one night before the exam as well. Okay. Thank you very much.